Good morning. You're watching All You Need to Know on BloombergQuint Live, and I'm Alex Matthew. First, the headlines. Iran fires a series of rockets at two Iraqi bases early this morning. The extent of damage and casualties remains unclear. The Indian economy is set to grow at the slowest rate since 2008-2009, as per the first advance estimates. It pegs the FY20 GDP growth at 5%. The latest amendment to the Insolvency and Bankruptcy Code bars promoters from taking part in the resolution process in any form. The government warns employees of public sector units to stay away from the Bharat Bandh that was called by 10 central trade unions today or face consequences. And the Delhi High Court issues death warrants for 4 of the convicts of the 2012 Delhi gang rape and murder case. The convicts will be executed on the 22nd of January. Now, let's talk about the U.S. markets. They had a weak day of trade on Tuesday. Benchmark indices ended lower as prospects of escalating tensions in the Middle East overshadowed favorable economic data. Now, Ranita Young of Bloomberg News wraps up Tuesday's action on Wall Street in this report.
U.S. stocks closed out lower in a mixed session as investors tried to assess the Iranian conflict and whatever kind of trouble it may cause markets, with the positive signals coming from the U.S. economy. During the session, we saw the S&P 500 erasing most of its losses after that decline that was sparked by Iran tensions. Now, we also saw quite a bit of companies' news. Pier 1 Imports sliding after saying it will cut 40% of its staff at its headquarters. U.S. oil producer Apache rising more than 20% at some point during the session after a significant oil discovery. Meanwhile, gold was still around that 6-year high, and the Bloomberg Dollar Spot Index was hovering around unchanged. But WTI crude oil did dip earlier in the session. And the U.S. monthly employment report will come out on Friday, give us a more rounded out picture of the economy. That's a look at your Wall Street action on Tuesday. In New York, I'm Ranita Young for Bloomberg News.
Now, bear in mind that all of that took place earlier in the day. Early morning, this morning, there were attacks that were carried out by Iran on two U.S. bases, on 2 bases in Iraq that house U.S. and coalition forces. And after that, there's been a nosedive in several markets globally, including U.S. indices, which have fallen as much as 1.2%, 1.1% for the Dow. Of course, crude oil prices have spiked naturally, and Brent crude is trading above the $70 per barrel mark last I checked. There you have it. 70.7 is the last reading, as much as 3.6% higher. Let's take a look at the Asian markets, though. Rosalind Chin is joining us live from the Bloomberg studios in Hong Kong. Good morning, Rosalind. Now, yesterday we had a bit of a breather, but we're back to the high level of fear and tension that we saw at the start of the week.
You're definitely right. Let's update you on some of those moves in the market. We've got US futures are falling by more than 1%, down 1.3%. Right now, of course, as you mentioned, oil spiking, WTI rising again. It's currently at 64.89 a barrel, Brent at 70.76. Gold, of course, one of the havens, jumped above $1,600. Right now, it's at $1,002 an ounce. Of course, spiking because it's one of those havens that investors look for in these times of uncertainty. The yen also, of course, one of those havens, currently at 107.85. So pretty much everything is moving right now. All those havens really seeing a bit of a jump after, as you mentioned, that relative calm that came in on Tuesday. In Asia, of course, this is affecting the region. We've got the MSCI Asia Pacific losing 1.2%. All the major indices pointing lower. We've got the Hang Seng, which opened just a few moments ago, down by 1.4%. The Shanghai Composite down nearly 0.5%. Nikkei down 2.5%. The Topix losing 2.29%. What happens next? I think this is what many investors are now starting to question. You know, depends a lot on the U.S. response. That, of course, could continue to drive these havens higher, that the yen and gold, for example, especially if there becomes a major escalation in the tensions between the U.S. and Iran. The topics, of course, we saw falling today. Almost every industry sector there falling, except for those related to energy, especially energy explorers. South Korea's finance minister says they're closely monitoring the stock and FX markets on the back back of this retaliatory attack from Iran. The Kospi right now losing 1.6%, and really pretty much elsewhere in the region all pointing low. The S&P ASX 200 also down by more than 1%. China hasn't reacted as much as the other markets, and in fact we also saw after the initial attack on the Iranian general, that also hadn't moved as much as some of the markets. It's still in negative territory, though. Quick look on the corporate front. Samsung, we had its fourth quarter results, preliminary results out earlier this morning. Not as bad as expected. Operating income falling 34% to $6.1 billion, which, believe it or not, is actually better than expected. Beating estimates because chip memory prices are beginning to improve, climbing out of a persistent downturn. So things slightly looking better for Samsung. But a lot of that, of course, is coming on the background of these greater tensions between the US and Iran, putting a lot more fear into investors today. Back to you.
Thanks so much for that, Rosalind. Now, we are hearing that the US president may be speaking at some point. Of course, we'll bring you live updates as and when we get them. For now, let's turn to the international headlines. What's making headlines across the globe? Sue Keenan of Bloomberg News brings you the first word headlines.
We're going to start with the latest on the former Nissan chairman. The toppled Nissan boss, Carlos Ghosn, says the carmaker's internal investigation that led to his ouster was, quote, never about finding the truth, and that he wasn't interviewed himself as part of the probe. Ghosn is expected to hold a news conference later, promising to name the people he says engineered a coup to destroy him. Tokyo is keeping up the pressure on Ghosn, issuing an arrest warrant for his wife, Carol. Prosecutors accuse her of lying under oath last year. To India now, Bollywood star Deepika Padukone has joined protesters at a prominent university in New Delhi just 2 days after masked attackers beat students and teachers on the campus. Local media say the actor stayed more than 15 minutes at the rally and spoke to some of the students who were attacked. The violence at JNU on Sunday comes amid simmering anger at Narendra Modi's new religion-based citizenship law. And to Australia, the effects of the bushfires taking place in the country are being felt halfway around the world. Smoke from the blazes has been detected in the skies above Buenos Aires, about 12,000 kilometers away from Sydney. The fires have killed at least 24 people and up to 1 billion animals so far, and are so large they are generating their own weather systems, causing dry lightning strikes that in turn ignite even more blazes. Global news 24 hours a day, on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Sue Keenan. This is Bloomberg.
All right, let's turn to the big news from back home and basically economic data that was spoken about yesterday evening. India may grow at its slowest pace since the global economic crisis of 2008-2009. The government's first advance estimates peg growth at 5% for the current financial year. The number also puts the government's fiscal deficit target under threat. Ira Dugal takes us through the main takeaways from the numbers.
The first advance estimates of FY20 GDP in many ways reinforce all the fears that you've had about the economy. They tell you that the economy is weak on many fronts and that policy options are quite limited at this stage. The data came in on Tuesday telling you that GDP is expected to grow at 5% in FY20. Now, this comes as no surprise. You know that in the first half of the year, you've seen sub 5% growth. The RBI has pegged down its estimates at 5%. So the CSO estimates at 5%, real GDP growth are more or less in line with that. If you look back, you'll see that this is the lowest we've seen in terms of GDP growth all the way down to the financial crisis period. I'm just going to clarify here that BloombergQuint is using the back series of the current GDP series so that you have one comparable series across which we are looking at the growth rates. And if you go on the basis of that, then this is the lowest since the financial crisis period. Now, the numbers stack up in this manner for GDP, GVA, and nominal GDP growth. And of those three indicators, it is a nominal GDP growth which is the most worrying, down from 11.2% to 7.5%. That's a weak number, a very, very weak number for India, has implications not just for corporate earnings, but most importantly for the government's finances, and I'll come to that in a minute. But the GVA growth number at 4.9% and the GDP number at 5% are much lower as well compared to what we had seen last year. Now let's focus on the fiscal implications of this number, because remember, the real reason you get a first estimate, a first advance estimate for GDP is because it's important to the budget making exercise. It will now be the new denominator for the revised estimates that the government puts in the budget, and it in some ways will inform the FY21 projections as well. So if you do the math based on the new numbers, what you had was a fiscal deficit of 7 lakh crore, a little bit above that, and that divided by the projected nominal GDP of 211 lakh crore gave you a fiscal deficit of 3.3% of GDP. Now the denominator has changed and is lower than what was expected. So on the same absolute amount of fiscal deficit, you will get a fiscal deficit as a percentage of GDP at 3.44%. So that is already a fiscal slippage in terms of just actual numbers. Now what the final numbers look like based on the revenue that the government garners, the expenditure cuts it actually puts in place, will be known at the time of the budget. But you know, based on these numbers, that is going to be a tough fiscal management act for the government in budget FY21, both on the backward-looking numbers and in the forward-looking numbers. Let's get back to GDP now and tell you what the internals of the GDP number look like based on the first advance estimate. These are some of the key sectors. Agriculture is more or less steady, but the real worry point is on manufacturing. 2% growth projected in manufacturing for FY20 compared to nearly 7% growth in the previous years. Remember, this is a large employment-generating sector, so the job implications of a weak manufacturing sector are important to focus on, although you may not get numbers. Similar story playing out in construction. 8.7% growth in FY19, 3.2% growth in FY20. Electricity and public utilities weaker at 5.4% compared to 7%. Some of the other sectors where we know there have been pressures, for instance, the financial, real estate and professional services sectors, there you've got growth coming in at 6.4% versus 7.4% last year. The segment which is held steady is the government spending supported public administration and defense segment, where growth is expected to be higher at 9.1% compared to 8.6% last year. That's the sectoral breakup. If you deviate up from the expenditure side, again, the most worrying number is the fact that gross fixed capital formation has literally fallen off a cliff to just under 1% growth after seeing a slight pickup in the previous year. Why has that happened? Well, a couple of reasons for it. One of it might be financing, the other may be confidence, and the third may be a slowdown in consumption, which has meant that capacity utilization numbers, which had just about started to pick up, has started to fall again, and capacity utilization is below 70%. The consumption story is also worrying because private consumption was the one thing that had been going right and had been reasonably steady, as you can see, for the Indian economy. Well, now you've seen private consumption growth fall to below 6% as well, and that's well below trend. Government spending remains strong. Some people have questioned that number because remember, this government spending number is based on the first 2 quarters and some information of the third quarter, but the government may be looking to cut expenditure in the fourth quarter. So the final numbers, according to at least 2 economists we spoke to, which is Shogato Bhattacharya of Axis Bank and Soumyakanti Ghosh of SBI, the final GDP numbers for FY20 may actually end up being lower than the first advance estimates. Well, that only worsens what you know is a really bad picture for the Indian economy.
All right. Well, that's essentially how things stand. Both cues domestically and internationally pointing to a weak setup at the start of trade today. Let's take a closer look at how we're set up. Agam Vakil is joining me to tell you all about the trade setup for the day and also what's happening in the futures and options space. Morning, Agam. Not the best cues, to put it lightly.
To put it lightly, Alex, because it's not every day that you see a 1.6% downtick on the SGX Nifty. So this certainly seems like, well, we could very well see some pressure on account of that retaliation from Iran that we've seen of late. A 1.6% decline, 200 points shaved off the SGX Nifty futures. Let's see how our opening pans out today. We do have, well, about 0.5% gains yesterday, and it was a little bit of a surprising move. But mid-cap and small-cap indices, of course, looking at advances too, and some advances for the banking indices. But, this may not hold for now, considering the way the SGX Nifty futures are reacting along with the rest of the world markets. We saw mixed cues, but, well, there was weakness all around as far as some of your ADRs are concerned. And, of course, say for something like a Dr. Reddy's, which largely remain unchanged. But moving on to fund flows, FI sold to the tune of 682 odd crores. DI is buying stock worth around 311 odd crores on a net basis. Moving on to your contributors, we did have HDFC Bank, Reliance Industries hold on to the gains and will probably lifting the indices higher. That cannot be said when it comes to some of the other losers. So Infosys, ICICI Bank and Bharti Airtel among many others, which were weighing down on the indices. And coming down to your futures and options space, there was further unwinding despite the fact that we saw the futures advance, unwinding worth 7%. And, well, in the Bank Nifty futures, we're looking at, well, some amount of buying coming through, surprisingly. This is likely to unwind today as well, at least in the earlier in the session. And, of course, we are looking at not much has changed in terms of the open interest range. But today, should we see the Nifty go below 12,000 and hold below 12,000, then you never know. Some things may very well change on the lower end of things. So a lot of unwinding around the 12,200 call. And in terms of the WIX, that came off surprisingly by around 1%. It's likely to rise once again. The Nifty put call ratio also, well, didn't move as high. It did come to around 1.2 against 1.1 in terms of stocks. What we are watching out for is NMDC, RBL Bank, Mahanagar Gas, all seeing an increase in open interest. Not too much in terms of change in spot, and in terms of unwinding, we are keeping an eye on HPCL, Mindtree and Pidilite. All in all, Alex, it could very well start on a very weak note today.
Absolutely. Thanks so much for that, Agam. Take a closer look at some of the stocks that are in the news. Somit Sarkar is joining me to tell you all about that. Good morning, Somit. What's on your list today?
Good morning, Alex. I'll start off with Yes Bank because the board will be meeting on January 10th to consider fundraising. Along with that, Tata Steel, because their arm TS Alloy has received a letter of intent for grant of mining lease for 50 years for the Saruabhil chromite mining block from the Orissa government. Navin Fluorine, because they have commenced production on the company's newly added capacity in Madhya Pradesh. NCL Industries, because they came out with a quarterly update with their saying that the cement production for the third quarter of financial year 2020 was down nearly 23% compared to last year, while dispatches, that is sales, were down nearly 22% compared to last year. NBCC, because they have secured businesses worth nearly 1,090 crore rupees for the month of December. And this is a long list of defaults that have happened and came out on the exchanges yesterday. Suzlon Energy, JP Infratech, Reliance Communication, HCC, Gayatri Projects, Religare Enterprises, Reliance Power and Reliance Naval all have defaulted on loans which were due on 31st December. Now the amount for these default range between 83 crore to 28,825 crore rupees. That is the biggest amount for Reliance Communication, that they have defaulted on loans worth 28,825 crore rupees on December 31st.
All right, thanks so much for that, Somit. Now, you heard about the fiscal deficit, and in the context of the finances of the government, the Finance Ministry has issued a circular to all government ministries asking them to curtail spending, not block one's respective departments to spend up to 25% of the budgetary allocation compared to the cap of 33%. So where does the government have room to prune expenditure? Nikunjori joins us with the answer.
The government, finding itself in a fiscal bind, is looking to cut its spending by about 2 lakh crore rupees in the current financial year. The cut in expenditure is mainly because of the sluggish tax revenues and an ambitious divestment target which the government is currently struggling to achieve. The Finance Ministry had also written to various government departments to curtail their spending in the last quarter of the financial year, which is Jan-March, to 25% of the budget estimate allocated for each of the government departments. This spending cap earlier was 33%, and various government departments could spend 33% of the budgeted allocation in the last quarter of the financial year. Now this change, the spending cap, has been put by the Finance Ministry, keeping under consideration the current fiscal position of the government. Now, just to look at as to where the government could end up saving or cutting its expenditure for the current financial year, the Ministry of Agriculture and Farmer Welfare has spent only 49% of the budgeted allocation given to this particular department of about 1.38 lakh crore rupees. This primarily is on account of lower than expected or lower than budgeted disbursals under the PM Kisan scheme, which is a minimum income support scheme for farmers that the government had announced in the interim budget of 2019-20. Out of the 75,000 crore rupees allocated for the PM Kisan scheme, the government has spent only 45,256 crore rupees under the PM Kisan initiative. This would lead to a sizable saving for the government from the allocation that has been made under this particular scheme. Besides this, the Ministry of Road Transport and Highways has also spent only about 63% of the budgeted allocation of about 83,000 crore rupees for the current financial year as on November 30th. And the reason that for this spending could be the project delays that the Ministry of Road Transport and Highways could be facing. The other departments where the government might end up spending less in the current financial year are the Ministry of Rural Development, where the government has spent only 70% of the 1.1 lakh crore rupees allocated in the budget, and Ministry of Consumer Affairs, Food and Public Distribution, where the government has ended up spending only about 69% of the budgeted 1.94 lakh crore rupees in the budget. Over to you.
All right, well, there you have it. That's with regard to the finances of government. Now, the Insolvency and Bankruptcy Board of India has amended the norms governing the liquidation of a company under the Insolvency and Bankruptcy Code. The latest amendment has barred promoters from participating in the process at any level. So, what is the impact of this move? Payaswini Upadhyay spoke to Suharsh Sinha of AZB and R.K. Bansal of Edelweiss ARC, and this is what they had to say.
Even a liquidator can propose a scheme of arrangement. So therefore, if a scheme is proposed by the ex-promoters and the liquidator then supports it and puts it before the COC, then technically under Companies Act, it was not prohibited. If you read that with Section 35, I believe, of the IBC, which says that a sale of assets and liquidation cannot take place to the promoters of the company, there was an interpretation that a scheme of arrangement is not a sale of assets, and therefore promoters are not debarred from proposing or acquiring assets under a scheme of arrangement under IBC. That there was a very, I think a tenable legal argument could have been made in that respect. But that was completely against the spirit of IBC, because the spirit of IBC was that in a resolution scenario, the 29A debarred promoter should not be allowed to re-enter. And if you allow them to come back via a scheme in the liquidation scenario, then that was obviously a huge moral hazard and would lead to perverse incentives. The NCLT in Gujarat, NRE Coke, I think had held that it is permissible, promoters are not debarred, but then subsequently NCLAT clearly said that even under a scheme of arrangement, the promoters are debarred. So I think the judiciary was categorical, the NCLAT was categorical, but there was still some scope for doubt if you read the bare text of the law. And I'm glad that the IBBI has not clarified it, that even for a scheme, the 29A debarred persons are not allowed to come back into the company or acquire assets from the company.
Okay, Mr. Bansal, the dilemma that Suharsh spoke of was obviously that, look, via 29A, promoters have been barred from submitting resolution plans, so why are you allowing them at the liquidation stage? The counter argument to which so far has been that you have taken the company through the resolution process, and since there is no buyer or bidder in the market, rather than liquidating the asset, why not give it in the hands of the promoter, probably the only entity out there in the market who's still willing to take back the asset. Where are you on this side, on this debate, and also what do you see as the implications now of these amended rules, which have now, given a blanket sort of answer or a no to promoter participation even via the scheme route?
Yes, yeah, my feeling is I think we are mixing up the issue. If you are saying that, let us say, we should allow the promoter to participate in liquidation because there was no resolution plan and no other person came forward, right? In that case, we should allow him to participate in the resolution process itself. I mean, in that case, we should relax the Section 29A itself. But that's a different topic of debate, so I am not going there. And as of now, I feel because we are not allowing him to give a resolution plan, naturally we don't expect him to participate in liquidation, because otherwise the tendency would be to ensure that company goes into liquidation and then the promoter tries to buy at a much lower price. Now that is why if you see the restriction in today's rule is also there, even the lender, when he wants to sell secured lender, the asset outside, even then he is not eligible to sell to this guy. Otherwise, maybe the one lender wants to sell the asset outside, taking the help of SurfaceSea, not relinquishing in charge. Then also there is a restriction now. This is a new concept. So technically, under SurfaceSea, a promoter can always buy the asset back, but that is with the full dues payment. So here we are not discussing the full dues payment. But I agree with you in some way that if you are not getting a resolution plan, if you are not getting some buyer in liquidation, maybe at some stage we should allow the existing broker promoter because they know the account better. But I would only say that then we should allow him to give a resolution plan itself. Why to go for liquidation?
All right. Well, several stories just like that one on the website BloombergQuint.com. You should actually check it out as of now, and you'll find a couple more stories. Let me tell you about them. The first one, the government has asked public sector undertakings to dissuade their employees from participating in the Bharat Bandh that has been called today, and advised them to prepare a contingency plan to ensure smooth functioning of the enterprises. Now, the 10 central trade unions have said that around 25 crore people will participate in a nationwide strike today to protest against the government's so-called anti-people policies. The government will form a panel that will suggest measures to check evasion of goods and services tax and fraudulent refund claims. The panel, comprising officers, will come up with a standard operating procedure within a week that will be implemented by the end of January, according to an official who spoke to BloombergQuint. All right, well, that's all you need to know going into trade today, but do stay tuned. There's lots more coming up in just a short while. This is BloombergQuint.